Hey, John, welcome to another week of Markman on the markets. And honestly, what a week it's been. Crazy week. I don't think any one of us could have predicted where we are this week, but the whole entire market is up and in the green by the end of the
What
quarter.
do you mean nobody could foresee it? Our timing model foresaw it. At the beginning of the month, the program we call the Loop, which is really just a market timing program.
Yeah.
We recommended it at the beginning of the week. We recommended a leveraged position in the Nasdaq 100 at the beginning of the week. It's up 9% in the past 5 days. So I don't think you can say that no one could have predicted it, because actually our readers saw us predict it.
Fair enough. I guess no one else but Markman Capital may have predicted this ending to the week. Anyways, it's still quite a predicament.
But here's the deal. Despite the Federal Reserve's attempt to chill the market
Yeah.
and chill the economy, the Nasdaq 100 was up a stunning 20.7% in the first quarter. That's, if you multiply that times 4, if you look at an annualized number, that means that the market could be, by the end of the year, it could be up over almost 100%.
That seems pretty unbelievable. I'm not gonna lie to you.
You can't really say.
Yeah.
You can't really annualize a big number like that. But I'm just saying that that's the scale of what we're talking about, like almost 100% for the year. However, I have to point out that a year ago, the market was down 33%, 34%. So even though it's come back 20% in the first quarter, it's still down on a year-over-year basis. Which you might think to yourself, well, that favors bears. No, it really favors the bulls, because once
Why?
the bears start covering their positions, and then they start, first they have to buy back their positions. That raises the value of stocks. In addition to people who are buying the stocks for fundamental reasons, you got this new technical reason that people have to buy stocks to cover, as the bears cover their shorts. And then at some point you get to even, and the bears decide, well, maybe being negative was the wrong thing to do. Let's go along. So now you have another huge group of people who want to buy stocks and push stocks higher. So it's kind of a neat period, because after a certain point, after about another 5%, there's going to be very, very little resistance on charts to stocks moving higher. And fundamentally, they should be moving higher, because earnings are coming in so far. Now, next week is the start of earnings season, when we'll look at the company's results over the first quarter. But so far, both with stocks that report out of sequence, and also just looking at stocks that have reported so far, earnings look pretty good. much better than the pessimists have been expecting.
Yeah.
So
I guess that kind of makes sense. I mean, to a certain degree, a lot of the tech companies probably were very bloated, and that they probably did need to make cuts to those bloated sections.
Well, it's funny, because that's kind of exactly what Zuckerberg is saying when he cut rates. He cut jobs at Instagram and Facebook.
Yeah.
He wants this year to be the year of efficiency.
Yeah, that makes sense.
It means him and all the others who follow him, because he's such a leader. They're going to all try to be as efficient as possible. Really cut down, see how much more work they can get out of the people who remain.
Yeah, that makes a lot of sense. I mean, you know this, but I did used to work at a company that did build Oculus offices on behalf of Facebook, or at least manage those. And the amount of opulence thrown around there was ridiculous. And I remember even when I was there, they threw their design term for their newer buildings was they wanted the optics of opulence to be less. So they wanted their offices to still be nice, but to look but for them not to look as nice as they were. And what that meant was, not, instead of buying $100,000 tables on custom pulley systems, it meant maybe don't put the custom pulley system on the $100,000 table. So it only makes sense that for a certain while you really have to start cutting people where you might be overspending as well. So I guess but maybe this is the first time tech companies have had to do this. So is that why this is so surprising?
No, it's not the first time. What happened really was during the pandemic, and once the pandemic was in its worst phase, and we realized people were going to be home, a lot of companies like Microsoft, Amazon, and Meta just went out and hired a lot more people, because they thought they were going to have to really service a lot more people. They're going to suddenly be home and needing things for home instead of for their offices, and so they got bloated it really only showed up once demand receded a little bit with higher interest rates, and now they're like, huh, maybe we could, instead of having 100-man teams, we can have 80-man teams, and just make those remaining 80 players work harder.
Yeah.
So I
Maybe integrate a little chat GPT into their workflow.
exactly. I mean, it's too bad for those people who are caught in the wave of firings. But at the same time, one of the things that is so true is that if you look out through the history of the economy and the markets, when you lose engineers, when they lose engineers in Meta, Microsoft, etc., those engineers don't just collect unemployment checks. They start their own companies, maybe on a shoestring because their lending is not going as smoothly as it was 6 months to a year ago, and they create new companies. Microsoft was a great example. It came public during one of the worst periods of the stock market in recent history. So I mean, what I'm trying to say is that these periods when the large companies fire a whole bunch of engineers can actually be good for the market, because these guys go out and their backs are against the wall. They need to make some money, so they come up with something great, and all of a sudden, these guys who got fired 6 months ago are like leading IPOs, billion-dollar IPOs, like a year and a half later.
Oh, that's cool. Okay, so you're basically like taking, when a company has all those talented engineers, granted, hopefully they are talented, they are kind of not gatekeeping, but hoarding all of the intellect that could go into additional products that could be developed to help the economy as well. So by firing them in mass, you're basically having a bunch of people who could be making companies. That's pretty cool.
Yeah, and that's what happens. So
that's cool.
I think we'll look back on this period and say, well, look at company A, B, C, D, and E. The heads of those companies were all fired, by Meta and Amazon and Microsoft.
So what do you think they're going to call this period? Is there going to be a term like not like the Great Recession, or like
the Great Rebound?
The Great Rebound. Anyways, so I had another question for.
Really good question, Joe. I'm going to actually think about that, because that's really a cool question.
Yeah, like what are you going to call it?
Volatility particularly in the Nasdaq 100 has been with us for a long time. I remember back in 1999. I think, what were you, like 6 years old?
Yes, 7 maybe.
So you probably don't remember this, but the Nasdaq went up 100% in 1999.
Mm-hmm.
100%. But here's the interesting thing: there were 4 separate 10% declines within that 100% move. So
it just rebounded more than it dropped each time it dropped?
Exactly. We go up like 20%, come back, 10% go up, 40% come down, 15% go up.
Wow.
60. It was wild. So you can have in our lifetime, in my recent history, we've seen those kinds of swings. And so I think that I wouldn't be a bear and dismiss the huge move of the Nasdaq in the beginning, in the first quarter of this year. You want to say, like, they may pull back, bring off some of the from the fluff, and I can already see that it didn't happen yet, but it probably will in the next couple of weeks. And you might say to yourself, well, who's going to be the beneficiary of that money that's leaving the Nasdaq and going someplace else?
Yeah.
Well, I don't know if you knew this, but the drug companies, the big pharmaceuticals, they've had a terrible year this year so far. Johnson & Johnson has literally been down like every day. Pfizer has been down horribly. Moderna, which is a company that makes vaccines, was very important to making the COVID vaccine. It has had a terrible first quarter. But, and here's the big but, and you look at their charts, as investors get sort of prepared for them to report earnings next week and the week after, you can see these healthcare stocks are definitely either slowing down their rate of descent or starting to move sideways. I think in probably a month or two, we'll see that it came down. They came down, made a saucer, and now they're moving up the right side of their. My hand in the right place.
Yeah.
They come down, move over, and then they come up the other side, and they have a saucer pattern that that where you can draw a straight line between the right side and the left side of the formation. You can see if they move up higher than where they were, they have a great deal of movement ahead of them because of a lack of resistance. So I think probably to look forward, I would say that the drug makers might have the best second quarter opportunities because
Okay.
they've done in
So
part because they've done worse in the first quarter.
so Moderna, for example, does the stock drop? Does the price drop momentarily because the past price was predicated on potential implementation of like more vaccines, or like was there a past? Basically, what I'm asking is was there like a past report that indicated in the future there would be a more need for whatever they're selling? In this case, it was vaccines. And now that there's not a need for that thing as much, is that why the price right now is dropping? Only because the future cash flow is potentially not as big as it once thought it should be? Or
I think it was that, and they had fewer partnerships with pharma companies than had been anticipated.
oh,
They,
okay,
however, have a big relation, a very strong and new and important relationship with Merck, and I do think Moderna is going to. It's one of those stocks that could do very well over the rest of the
okay.
year. I think it's being misunderstood.
So to change subjects a little bit, one stat I saw and I don't understand at all is that the real estate industry jumped 2.6% this past week, as in more houses were being bought than in the prior week. How can the real estate market becoming more competitive while rates are still going up?
Well, and that's just the thing. Rates are expected to peak in the coming quarter,
Yeah.
coming couple of months, and then start to go down. Now, the Fed chair, Jerome Powell, has said that he doesn't see the potential for cutting rates throughout the rest of the year, but at Fed meetings until the end of the year. But as we have discussed many times in the past, the Fed doesn't really set rates.
Yeah.
The market sets rates, and the Fed, primarily accepts them. So I think that investors are looking forward. They're looking over the trough.
Mm-hmm.
The term is looking over the trough to the future and saying, well, we've already discounted. 2022, when the market was bad, that whole period discounted the idea that business would be slower this year. So the next thing to look forward to is a rebound, and I think that's what investors they're looking around the corner, seeing a rebound in earnings that could take place over the summer and into the end of the year.
So basically, there's still deals to find now, even if you could potentially wait a couple months to get a slightly better rate on that money for that deal. There's still deals now, okay. Versus
From a seasonality point of view, April is the single best month of the year. And when from Bespoke Investment Group was published earlier this week, when you have a really terrible year like 2022, the market was down over 30%, and then you have a good first quarter. The rest of the year tends to be very good. Not only it tends to be, but every time you've had a negative year followed by a positive quarter, for the rest of that year, what we call ROW, rest of year, the market tends to go higher. And not only tends, but has gone higher every time, and by more than 10%. So there's lots of things to worry about. The Fed, banking, the war in Ukraine, and any number of other things. But the market tends to discount all the negatives quite quickly and move on.
Yeah. So
market rose during World War II.
You seem quite excited. Why are you excited for this next market cycle?
I'm excited because a lot of the stocks that are in the lead now, like Microsoft and Meta and Tesla, they're still down a lot from where they were
22.
You look at these charts, like Microsoft, if it can clear the current resistance, actually, it just did that on Friday. It's got a huge path toward its all-time high, which was in the middle of last year, August. And all these stocks do. Tesla has a big potential move higher. Meta has a big potential move higher. AMD, Advanced Micro Devices, has a huge available to it. As you know, we really like the semiconductor equipment makers.
Yeah.
AMAT, LRCX, KLAC, and the others. There are a lot new semiconductor capacity being built in Arizona, and all those new gigantic factories that are being mandated by the U.S. government need semiconductor making equipment, and that's why starting to have this. We've had a boom, basically for the past 9 to 12 months in these stocks, and they kind of leveled off over the last couple of months, and now they're getting going again. So those are the kind of stocks I'm going to be recommending to my customers.
Oh, cool. So you're excited because this is a great opportunity to get back into the market then for all of us who've had lots of cash sitting on the side waiting to put it into action. And we're getting, if we're not there now, we're getting close to actually being able to allocate that cash in a profitable way.
I think so. I mean,
Yeah.
in a sensible way, with good stocks that are well capitalized,
Yeah.
smart management, good earnings, all those things will be rewarded over the rest of this year.
Well, I know one of your long-term themes, and I'm beginning to realize what this really means, but one of your long-term themes so has been most stocks suck. And what that means to me, really right now, is that a lot of people are looking for that one stock, Tesla from 15 years ago, essentially, to put all their money in and be so sure of it right now. And I think what we're seeing here, at least with this trend in the stocks you're recommending, they might not be the sexiest companies in the world, Nvidia, Meta, but there's still big opportunities to be made because, again, most stocks suck.
Yeah, most stocks suck, and that's why I think our business has done well because we're really able to find the stocks that don't suck. There's probably only about 70 to 100 stocks that are worth owning over the next 2 or 3 years, at least 5 years, and we help members find those stocks and hold on to them even even when there's a dip or some concerns about the market, about something major like the mini banking crisis we had 2 weeks ago.
Yeah, I think you were on the Lead Lag live Twitter Spaces this past Friday, and I pulled out one of your quotes. I think you dived too in here, but I thought it was hilarious. You called banks essentially a giant box of leverage that can go to zero overnight.
Yeah,
pretty hilarious.
If you think of banks, if people don't think of banks the right way, here's how a bank works. I bring in cash deposit, right? I'm a business owner and I have cash. So I bring in some cash and I give it to the bank, and the bank pays me, let's say, what are they making, like 1 or 2% in passport savings. But then what they actually do with that money that they give me is they go out and lend it to other people, at a much higher rate. So that all works just fine until there's something happens to the deposits that are being used as collateral for these other loans. If you take out take out that layer of deposits, the whole structure on which higher prices for banks are predicated falls apart. I mean, there really aren't any other businesses where the customers really have control over the health of their companies. So once people began to realize, again, kind of in their minds going back to the great financial crisis of 2002, 2009, that banks are amongst the few companies that we can buy that can literally disappear overnight. Like, you have a bank run, like we saw with Silicon Valley Bank. It was a bank run that lasted like 3 days, and they realized that they didn't have enough money, they didn't have enough bonds that they could sell to make good on what the depositors required, and you can see it went bankrupt in like a day.
Yeah.
Okay, well, that's not going to happen to Microsoft. That's not going to happen to Nvidia. I mean, they're incredibly well capitalized, much better capitalized than the banks, and so I think that there's been this rush from the banks over to big cap stocks, and I think it makes sense. I mean, I don't really think that money's going to switch back again anytime soon. It's going to take a long time before investors trust the banks again.
That makes a lot of sense. It really does. It's kind of interesting. I mean, it's kind of funny to compare a bank to a box, but essentially, I guess it kind of is true in a literal and figurative sense. Well, John, do you have anything else on your scorecard for this?
I would say that not only are big cap techs doing well, but big caps in general are doing better than small caps and medium-sized caps. Mm-hmm. So, for instance, the Russell 2000 this year is only up 2.7%. So compare that to 20% for the Nasdaq. 100, and you can see it, and that's
Yeah.
it shown these S&P 600 small caps actually fell in March by 5.2%, even though the Nasdaq was up 100%. So Nasdaq was up 100%, small caps were down 5% in the same month.
Okay, so smaller companies are
Why was that?
getting hit
Because
a lot
why
harder.
was that? It's because the Russell 2000 and the S&P 600, which are the measurement, they're the indexes with which we measure small caps. Those indexes are filled with regional banks and small oil companies. Energy took a big hit over the last quarter as well. So yeah, it's pretty interesting that you rarely see a dichotomy that dramatic. Let's say that again. The Russell 2000, 2.7%, and the Nasdaq 100 hit 22%. That's just, you see that kind of divergence very often. So the question is, are the techs going to come down, or are the regional banks going to move up? And I think that rather than the banking community, I think what you're really going to see is that some of that money flow into pharmaceutical makers.
Wow. Okay.
That really pulled back over the last quarter.
Could be interesting. I want to save this topic for next week, but I want to introduce it here. I want to know more about how the whole Russia, China, Brazil going off of the U.S. dollar for their oil reserves, what that means and how it affects Treasury bills. I don't want to get into it here, but I want to just make a comment that I want to talk about that next week. I think that's a pretty big deal.
Can you believe that you're actually saying, I want to hear more about Treasury bills?
Yeah. Well, after I read that history of debt book, and the whole 500-page book summarized into basically saying that as long as other people accept our treasuries and we have the world's largest army, we can effectively print money infinitely, and the economy still works. After kind of learning about that, all of a sudden I care about treasury bills. So yes and no. I can't believe I'm asking to hear more about that, but I can after learning about the history of debt. Anyways, I think that's a good note to end on. John, do you have any final words for everyone?
Yeah, well, I mean, one thing I didn't cover was that commodities also did very poorly over the last quarter. Do you know how much natural gas was down last quarter?
I don't know, but I saw a graph where it was basically almost straight down.
The ETF related to natural gas is down 51% in the last 3 months.
Wow.
And why is that? Lower demand, and we've never seen a run up in natural gas like the one we saw last year, and now we're seeing the opposite side, just the whole sector collapsing. And that's true with that's another thing that's interesting about our emphasis on big cap tech. You look at something like the commodities, where the energy companies looked very attractive last year, and now they're just falling apart. Why are they falling apart? Because basically their price is based largely on the value of the commodity. And if a commodity like natural gas goes down 50%, the energy companies are going to go down with it. So I think that's another thing we're going to be watching during the second quarter. What's going to happen to commodities?
Perfect. All right, we got one last question for everyone here. John was on a Twitter Spaces this past Friday, and that was a first for Markman Capital and a first for John. If any of y'all out here listen to Twitter Spaces, please leave a comment below or email us or do something and ask John anything. If you want Markman Capital to host some Twitter Spaces, let us know. It's a new medium for us, and we want to explore it if people want to hear it. Anyways, John, I think it's a good place to end it, and we'll talk soon.
Thanks, Joe. Have a great weekend.
All right, see you everyone. Bye.